This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, back in Chapter 14, we dealt with the CGT reliefs available for the individual. And you may recall they were many. We had entrepreneurs relief, we had rollover relief, we had gift relief, we had principal private residence relief, a range of different reliefs that worked in a variety of different ways. That was a very long and complex chapter. This chapter, dealing with the reliefs available to companies, is a very short chapter and isn't complicated at all. So very good news, because there is only one relief available within corporate tax so far as companies and chargeable gains are concerned. And that, as you'll see here at the beginning of Chapter 21, is rollover relief. Now remember what was usually happening. It's referred to here as the replacement of business assets. To be precise, the replacement of qualifying business assets. And what we had was a situation where an old qualifying business asset was sold and a new qualifying business asset was purchased. The idea was that on the sale of the one qualifying business asset, almost invariably a property used within the business, land and buildings there, that the sales proceeds would either be fully or at least partially reinvested in another qualifying business asset. And 99 times out of 100, the transactions that you'd see is we sell a property used in the trade and we replace it with another property to be used in that trade. And the only question about the amount of rollover relief that was then available was whether or not we had indeed completed a reinvestment of all of those sale proceeds. So the definition: a gain may be rolled over, i.e. deferred, where it arises, as we've just seen, on the disposal of a qualifying business asset, and where the sales proceeds are then reinvested in another qualifying business asset. Now again, the usual qualifying business asset we see, land and buildings. Another possibility here, fixed plant and machinery, is still come under the overall definition of rollover relief, but the manner of that deferral is very different, because fixed plant and machinery would equate to and would always be deemed to be what we call a depreciating asset. And that means that the manner of the deferral is very different to the normal rollover situation. Again, as we've said, both the old and the new assets must be used in the business. We're not going to get rollover where we sell an asset used in the business and then we buy an investment asset. These must be trading assets used within that trade. There are conditions for the relief to be applied. What happens in terms of how the relief works and what those conditions are. First of all, the gain that arises. It won't be immediately taxed in full if we have full reinvestment of all the proceeds, or at least in part if we have partial reinvestment. It's not taxed immediately, but it's not exempted. It's a deferral, so it's postponed until the company makes a disposal of the replacement asset, without, of course, further replacement. The process of rollover may continue from one transaction to another If every time you sell, you reinvest all the proceeds in another qualifying business asset, then all of the gain arising on any individual disposal will be rolled over. You'll continue to roll over. The only point at which any of the deferred gain will ever crystallize, or have to crystallize, obviously you have a choice about whether to claim rollover relief or not, but the only time when it will have to crystallize is where, following a disposal, the reinvestments that take place do not allow all of the sales proceeds to be reinvested. If you take out any money on the deal, then the amount that you take out on the deal, what you sell to what you buy, any amount of the proceeds retained, not reinvested, that amount of the gain will remain chargeable on here, well, the company, as we're dealing with corporate tax. How does this rollover work? The postponement is achieved by deducting the gain made on the old asset from the cost of the new asset. By making its cost lower by the amount of the deferred gain, it means that when it in turn is sold in the future, its gain is that much bigger. And at that point, as we just suggested, the gain may crystallise, but of course may continue to be deferred if we keep on reinvesting all of those proceeds at the point of every disposal when it is made. Where, of course, the disposal proceeds of the old asset are not fully reinvested, then the surplus retained reduces the amount of capital gain that can be rolled over. To the extent that we fail to reinvest proceeds in another qualifying business asset within, as we'll see in a moment, the qualifying time period within which the reinvestment must occur, if we take money out on the deal, then that amount of any gain that has arisen on the disposal will remain chargeable on the taxpayer. The time period involved for rollover relief to be available: the replacement asset must be bought in the period 12 months before to 36 months after the disposal of the old asset. Again, all the rules, the same rules as we had in Chapter 14 when dealing with individuals there. Nothing changes. Here, the reinvestment has to be within that 4-year window of opportunity, running from 12 months before, i.e. 1 year before the disposal date, through to 3 years, i.e. 36 months after that disposal date. That happening, you've still got lots of time in which to make your mind up about whether to claim rollover relief. A claim must be made within 4 years from the end of the accounting period in which the disposal occurred. Plenty of time. Now, ordinarily, you're going to make that claim well before that. You know that subject to a company having to pay tax on a quarterly basis through the quarterly instalment payment system, it's going to have to settle its tax liability 9 months and 1 day after the end of the chargeable accounting period. Well, presumably, by that point, you'll have made your mind up about whether or not to defer the gain. Logically, you would think that if you have an opportunity to defer a gain that you may or may not be paying tax on at a later point in time, that depends how long you keep on reinvesting, and at a time when tax rates, corporate tax rates, have been going down, it would seem like a very good idea indeed to defer gains. If the worst that can happen is at some future point in time, the amount of the gain crystallises and is taxed at a lower tax rate. Okay, you see in front of you a little example now. Again, a name we're probably familiar with from many of our examples. Villa Limited sold a property used in its trade for £600,000. Now, again, we can see here, imagine that we're dealing, for example, with an objective testing question, and we're dealing with the disposal. First thing you need to determine when dealing with such a disposal, who's doing the selling. Here, Villa Limited. So we now know that we're talking about corporate tax rather than personal tax. So Villa Limited, it's a corporate tax chargeable gains exercise. If it was an individual villa, then that, of course, would be personal tax and capital gains tax, CGT. So pick up who is doing the selling. So Villa Limited sold a property used in its trade. Used in its trade, i.e. this is a business, a trading asset, it's not an investment asset. Given the chapter that we're dealing with, we're talking about rollover relief, and as we've already explained in our introduction, what we know is that we must have qualifying business assets being both sold, as we're dealing with here, and separately, as we'll deal with in a few minutes' time, a qualifying business asset being purchased. Only if we dispose of and then reinvest in qualifying business assets will rollover relief be available to us. Okay, so it's a company, so it's corporate tax chargeable gains, selling a property used in its trade. Where this will lead to will be indeed rollover relief. But the first thing you've got to be able to determine is what's the chargeable gain. So it's sold for £600,000. We therefore need to know the cost. Here we go, the property had cost £400,000. And because it's corporate tax, we're dealing with Villa Limited doing the selling, then we know that indexation allowance will be available from the date acquired, if of course that was pre-December 2017, but then indexation frozen at and only available up to December 2017. So we've given it to you directly here. The indexation factor from the date of purchase through to December 17 was 0.2. Now again, we know that we go to 3 decimal places, and any real indexation factor is likely to go to 3 decimal places. We're just, for example purposes, using a nice more roundish number here of 0.2. Again, in terms of an examination question, you may not be given, as I have supplied you with there, the relevant indexation factor. You may be provided with both the indexation factor as here to December 17 and also an indexation factor through to the date of disposal. We have to, of course, know that this is the one to select, the one to December 17, when, even for corporate tax, indexation allowance was then frozen. So all I need you to do, if you haven't indeed already done it while I've been talking, is to work out the chargeable gain arising on this disposal. What we'll then see is, having got that chargeable gain, that then should be included within the corporate tax computation for the chargeable accounting period in which the sale took place. But of course, what you're going to be further supplied with is information about having sold this property, we of course we acquired another, and it's that which will lead to rollover. But firstly, if you'd be so kind, could you calculate the chargeable gain on this disposal, please? So pause it for now and then do that calculation for me. Okay, so it should have been a simple enough calculation of our chargeable gain. As we knew, the proceeds 600, the cost 400. So we're talking about an unindexed gain of 200,000, from which then we are able to deduct the indexation allowance. The indexation factor, 0.2, applied to the allowable cost. Again, don't make, as I think we've mentioned before, don't make the mistake, as I've seen so many students over the years make it, and that is when applying the indexation factor, get careless. And what they do is to index the last number they wrote down, i.e. the unindexed gain. And they go 0.2 times 200. No, remember the indexation allowance factor is applied to the allowable cost. So 0.2 times 400,000 is another £80,000 of indexation allowance now to deduct from that gain, therefore giving us a chargeable gain of £120,000. Now, if that was it, as we said before, then that would be it. That is what you'd include within the corporate tax computation for the chargeable accounting period in which the disposal took place. But of course, to make it worthy of an examination objective testing question for 2 marks, it's going to be about rollover. There's then any of 3 potential scenarios for rollover that they might put you in. Now again, if you've reminded yourself already of what we did back in Chapter 14 when dealing with rollover relief for individuals, then what you'll see here as these 3 possibilities should not come at all as a surprise. So we're told here, if you make a note of it, company purchases a replacement property, again it will be for use within the trade, as follows. Now the first 2 examples are freehold property. But what's the distinguishing characteristic between the first 2 scenarios? It is, of course, the cost. So in the first instance, the freehold property costing £750,000. What is the significance of that? Now about rollover, is it full rollover? Is it partial rollover? It is all about whether or not we have reinvested all of the sale proceeds. So what were our sales proceeds? We'd sold that original property for £600,000. So if we're now buying, as we see here, for £750,000, that therefore means full rollover relief. Again, assuming that the acquisition is made within the relevant 4-year window of opportunity that runs from 12 months before the disposal date all the way through to 3 years after the disposal date, then a rollover relief claim can subsequently be made. And what we know here is we sold for 600, we bought for 750. We have reinvested all of the proceeds, so this is full rollover relief. What does full rollover relief mean? It means that all of that chargeable gain of £120,000 will now be deferred. So in our corporate tax computation for the accounting period in question, there'll be nil chargeable gain. And instead, that gain is rolled over, it is deferred, by doing what with the £120,000? Again, the clue's in the name, roll over. We roll over that gain against the base cost of the newly acquired asset, that being 750. So 750 minus £120,000, the full deferred gain, 750 minus 120, well, what's that going to be? That's going to be, what, £630,000. So although this new freehold property here in point 1 has cost 750, as a result of the deferral, as a result of this rollover, the base cost to be used on its future disposal will not be its actual cost of 750, but its allowable cost of £630,000. Again, to repeat, that's the 750 actual cost minus the deferred gain of 120. Now, of course, if at that future point in time, whatever we sell the property for, we reinvest all of those proceeds, then all of that subsequent gain can again be continued to be deferred. The only time that any part of a gain that arose will arise and will crystallize immediately is when we fail to reinvest all of the sale proceeds. And that, of course, is the situation that we now see in the second of these three scenarios, because now the freehold property costs £550,000. Well, what does that mean? It means, of course, that having sold for 600, having bought for 550, that £50,000 of the proceeds have been taken out on the deal. The company has that spare cash available in its corporate bank account to spend. So to the extent that we fail to reinvest the sale proceeds, that amount of gain remains chargeable. So in your workings, if that was the only situation you were dealing with, you would already have computed the gain of 120. We would know that some figure of rollover relief was available, but having seen that we sold for 600 and bought for 550,000, that some of that gain will remain chargeable. So it is that chargeable gain, the remaining part of the gain that you can't defer, that we compute. What did we sell for? 600. What did you buy for? 550. How much cash have you taken out on the deal? 50,000. So that part of the gain remains chargeable. So the rollover relief is simply a balancing figure. That of the 120 that arose, 50 remains chargeable. On that basis, therefore, £70,000 will be the extent of the rollover relief. Remember, what do you do with that rollover relief? You deduct it from the base cost of the newly acquired asset. So your new property there that you bought had actually cost 550,000 minus the rollover relief of £70,000. Well, that therefore will equal a revised base cost, if my mental arithmetic is correct, of £480,000. We're going to reduce the actual cost, as we always do with rollover, by the amount of that rollover. Here, it's partial rollover, it's £70,000. On its future disposal, you use a base cost of 480. Remember, of course, as we're dealing with corporate tax, we have to think about indexation, but given now that we've gone past December 17, there won't be any indexation allowance in the future in relation to the disposal of this property that had actually cost us 550 but has a deemed cost of 480. So all you have to do in the future on its future disposal, take your proceeds less your cost, that's 480, and there will be your immediate chargeable gain. Does that crystallise at that point in time? Well, it depends, doesn't it? Do you again then reinvest all of those proceeds to allow full rollover, or some but not all, and therefore the best you can do is partial rollover? Okay, now there would be a typical little objective testing question for you to do there for a couple of marks. deal with the sale, calculate the gain, identify is it full or partial rollover. You think it would probably be partial rollover, like in this situation. Therefore, to the extent that you fail to reinvest the proceeds, sold for 600, bought for 550, that amount of the gain remains chargeable out of a figure of gain of 120, so there is the rollover. What do you do with it? You deduct it from the base cost of the newly acquired asset. Now again, remember, the objective testing question can ask whatever it wants to. It might ask you to determine how much chargeable gain will appear within the corporate tax computation of the accounting period. That would be 50,000 as a result of the deferral, the rollover relief claim. Or they might ask you to determine, as we've done here, what is the base cost of the newly acquired property there. So again, as ever with objective testing questions, it's true for all questions, but especially so with objective testing questions, do make sure that you've understood, you have properly interpreted what they want you to do. And you don't therefore spend your valuable time computing something that was not required. Where you could and should have got your 2 marks, you have instead committed a cardinal sin here, and that is you spent a lot of your time, or some of your time, valuable time, actually producing no marks at all, where you should have got 2 marks. So make sure you read those questions requirements very carefully. Okay, now that's 2 of the 3 situations dealt with. But then this third one. Now then, it is a 45-year leasehold property costing £650,000. We have to understand the difference between the freehold properties that we bought in options 1 and 2, and now this 45-year leasehold property bought in option 3. And what, again, if you've revised from chapter 14, your rollover relief issues, you should be able to recognise this, a 45-year leasehold property, as being what we call a depreciating asset, rather than a non-depreciating asset. Freehold properties, non-depreciating assets, rollover relief as we've just seen, whether it is full, whether it is partial. But where we see that we invest in a depreciating asset, now you've got to recognise it as such. Remember, what's the definition of a depreciating asset? An asset with a life of no more than 60 years. Hence the 45-year lease, that is less than 60. And what that means is this is a depreciating asset. The only other assets that you would see and be expected to recognise as being depreciating assets, well, that would be fixed plant and machinery, where again you wouldn't be told about any life on that. You would assume that the life of fixed plant and machinery is indeed going to be not more than 60 years. It is therefore a depreciating asset. So what does that mean? Well, we still, of course, have exactly the same chargeable gain that has arisen. And we're still going to get a deferral. Now, we use the same rules to begin with. Have we made the acquisition with the 1 year within the 1 year, the 12 months before, to the 3 years after the disposal date? And have we reinvested all of the proceeds, or just some of the proceeds, to know whether full deferral or partial deferral will take place? Well, here costs 650. We sold for 600. So the full gain of £120,000 will now be able to be deferred. The question is, when will it be deferred until? Now, you should know that it is the earlier of 3 events. And I'd like you, therefore, now to think what they are and to state what those 3 events are. If you can do that without looking in your notes, that would be great. But otherwise, look in your notes. Again, you won't have to go very far in this short chapter to find the section on depreciating assets, but you then should know what the deferral, or when the deferral will run out, and the deferred gain here, £120,000, will indeed then crystallise. Have a go at that, and again, I'll rejoin you in a moment. Well, here we go in your notes, as we can see here on depreciating assets. The only ones we have to know, fixed plant and machinery, as we mentioned, and as we're dealing with at the moment, a leasehold property with a life of 60 years or less. It's no more than 60 years there. And what then happens? If the new asset is a depreciating asset, the gain deferred is not deducted from the cost of the new asset, so we do not roll it over against the base cost of the newly acquired asset. Again, you may recall I've referred to the term holdover relief, but it's not one that you'll see within your material in terms of using Kaplan or BPP. But we can just talk about rollover, but it is very different to the normal rollover that we have seen, whether that be full or whether it be partial. What now happens is that we defer, we postpone that gain until the earliest, the earlier of, well, what do we think would be one obvious thing that would cause the gain to crystallise? The disposal of the new asset. So whenever you sell that 45-year, when you bought it, 45-year leasehold property, when you sell it, at that point, if not before, because this is the earlier of three dates, the disposal of the new asset will of course cause the deferred gain to crystallise. The assets have to be used within the trade. So the date the new asset ceases to be used in the trade. If instead of using it in the trade, we were, for example, to rent that out, it's changed from a trading asset to an investment asset, and on that basis, therefore, again, the deferred gain would crystallise at that point. But there is a finite limit to this, and that is 10 years after the new asset was acquired. So it's not after the disposal date of the one sold, but 10 years after the new asset was acquired. At that point, you still own the asset, you still use it in the trade, then at that point, that deferred gain will crystallise. So that date, whichever corporate tax computation, whichever chargeable accounting period that falls in, you will show in that period the chargeable gain of £120,000, then crystallising. But hey, if you've got the opportunity to be taxed on the same gain instead of now, but instead in 10 years' time, what are you going to do? I think again it's fairly obvious that we would choose to defer that gain. Now what you've got is three examples within the chapter which deal with the three scenarios that we've been looking at, i.e. either full rollover, partial rollover, or this reinvestment in a depreciating asset where we crystallise at the earlier of those three events. There's a final little point in here that's probably not an issue, but I mention it just in case. Whereas we've seen the replacement asset is a depreciating asset, here we bought the leasehold property. The gain is deferred as we've seen in B above there. However, if a non-depreciating asset is purchased before the deferred gain crystallises, so remember we sold a freehold, we bought a leasehold property, but a leasehold that is of no more than 60 years duration, this was a 45-year duration, that if a non-depreciating asset is purchased before that deferred gain crystallises, so imagine we sold a freehold, we bought a leasehold, and then what happens? We change our minds and we go back and we buy another freehold property. Then the original gain may be rolled over against the cost of the new non-depreciating asset. So it had originally only been held over, deferred, awaiting the crystallisation of the gain at the earlier of those three events. If before that gain crystallises, you buy, and of course it's the same issue, have you reinvested all the proceeds, but you reinvest in a non-depreciating asset or assets, then what had been merely held over, the deferral to the earlier of those events, can now be rolled over. And it will be rolled over, of course, against the cost of the new non-depreciating asset. In my example, the new freehold property purchased. And that means that that then gain will only crystallise on the sale of the non-depreciating asset. Well, I say that, but of course on the sale of the non-depreciating asset, again, what might happen? You take all the proceeds and you reinvest in another non-depreciating asset, and the rollover continues on. Okay, have a go at those 3 examples. Check out the answers in the back. Make sure that you're happy with them. And of course then, as ever at the end of chapters, there are elements of reading from technical articles for you to do and questions that you may also attempt. So make sure you review through all of those areas, please.